Welcome guys to a new video. So today we will talk about liquidity, and it's a term that is thrown around there a lot and is being overcomplicated, and it's not needed to be overcomplicated. So if you like this video, please leave a like, subscribe, or comment. Let us know how do you like this video and what topics in the future you want us to do. So let's get started to the video. Okay, so how to spot liquidity. So first, what is liquidity? And most important, like it says here, how to objectively trade liquidity and how to use this concept in our advantage. Okay, and this can be very, very hard somehow, but we will try to make it a bit more simple here for you guys. Okay, so how is this? What is liquidity? So liquidity is basically just orders sitting above or below a level. So how you can spot it? It's very, very easy. What you want to do is you want to identify the market ranging in a certain area. Okay, and this can be on your execution time frame, can be on your analysis time frame, but usually on the higher time frames, the higher the time frame, the less noise. Okay, so at the beginning you want to maybe not go too deep, too low on the time frame, so maybe just try to spot it on the 15 or above. Okay, so 15-minute and above. So what you want to see is price really ranging in a tight range. And what does this mean? Okay, this is very, very important. Many traders, when they see price ranging, they close their trading or charting platform and just go about their day, because in their mind, this is boring. But this could be far more. This is far from boring. Okay, this is very, very interesting once it happens, and you have to get very, very, very cautious, and you have to be very, very aware what's happening once the market is ranging. Why? This is where big institutions or big guys usually accumulate their positions, buys or sells. Okay, so it's easier for them to accumulate positions when the market is moving in a tight range than when the market is basically just moving up and down, up and down, up and down. Okay, because this is very, very easy for them to accumulate in every direction they want, if it's sell positions or it's buy positions. And how can we take advantage of that? Okay, so like said here, there are two potential scenarios that we can see once we have spotted liquidity. Okay, so once we have spotted price accumulating in a tight range, we know there may be orders sitting above, okay, and orders sitting below. So let us make it a bit simpler and don't overcomplicate it. So once we see price accumulating in a tight range, we know there are stop losses of sellers above, okay, which are in this case buy orders, and we have stop loss of sellers of buyers below, which are sell orders. Okay, so what you can see are two potential scenarios. Okay, and we will talk about them in this video. So let's talk about price taking by liquidity first. So what can happen after the accumulation is you can see price going above the range aggressively. And what do you want to do is be very, very aware what happens immediately after price breaking the range higher. Okay, so eventually we can be taking buy liquidity above, okay, which are stop losses of buyers, or you can see new buyers getting into the market and trying to trade the breakout. But what you can set before is a range above a certain above the accumulation, and you can hawk that zone, that buffer above the zone, and look for price maybe being rejected at these levels. So once you see price taking breaking above, inducing new buyers into the market, and taking our stop losses off the sellers, and then showing some signs of weakness, okay, and then coming back down, okay, into that range, you can maybe take some trades at this area, looking at price potentially going to lower levels, since we have shown signs of price taking buy side liquidity. Okay, so this is in the case when prices take the buy side liquidity and then continue lower. So this is a scenario that you can see very, very often. Okay, so price accumulates, breaks higher, shows some signs of weakness, and continues to drop lower. So it traps all the traders in this area. Okay, so this would be the sell scenario, but we can have another scenario as well, which would be the buy scenario, and this would be price taking out sell liquidity. So if price maybe goes here and then breaks below the range, okay, and above below the range, you also want to have a small range where you can wait if price will maybe respect it and show some signs of weakness. So in this case, prices take the stop loss of the buyers, which are sell orders, and you can see maybe new sellers getting into the market as well. And just like on the buy scenario, okay, just like when price takes out buy liquidity, you want to see the market to stabilize a bit around below the range, okay, and then showing some signs that it's already getting weaker to move to the downside, and then you can get in on a potential liquidity spike to the downside. Okay, so where you want to enter in this case is around here, okay, where price shows some signs of rejection of that same range. Okay, so what you want to do is enter here, okay, and maybe you take it as a scalp and you take it at the next structural level. Okay, and on the sell scenario, okay, on the sell scenario, you want to take a sell when price breaks above, shows some signs of weakness and price stopping, and then looking for price to close the range again. Okay, what you want to see is for price to maybe revisit these lows here or even lower. Okay, so this is how you can trade liquidity, how you can spot it, but please keep it to the higher time frames first, and then you go to the lower time frames once you have identified or worked quite a lot with this concept. Okay, so once you have really understood this concept, traded it a few times, back tested it, created clear rules for it, then you can go to the lower time frames. So I hope this video was helpful for you guys. If it was, leave a like, subscribe, and comment, and I see you guys in the next video.